An update to the barbell strategy. This is actually fun. Man, I love this stuff. All right, talked to a guy today from Exxon. Good guy. Real good guy, actually. He retired. And it made me think about it. I had a lady when I was at USA, and she was retiring from ExxonMobil. She lived in Houston. She worked in Houston, and she had, I don't know, friggin', we'll say $1 million. 500,000 in cash and 500,000 Exxon. I think she had $1 million in each now I think about it. Anyway, 500,000 in cash and 500,000 in Exxon. It was back in 2008, I think. 2009, 2008. Anyway, long story short. So when we did the financial plan, is actually interesting because the software said she's well diversified. And I was like, no, she wasn't, because the software looked at her Exxon and made it large cap. So it said she's large cap with cash. So it's a diversified portfolio. It wasn't. Long story short, we get to talking. I said, hey, Missy, whatever her name was. I said, Missy, you have too much in Exxon stock, blah, blah, blah. She said, look, I like Exxon. I like the dividend it pays. I'm just going to ride it out. I got enough cash to accommodate me if things go bad, but I'm going to just get the dividend, live off the dividend, and whatnot. I'm kind of paraphrasing this to some regard, but it's pretty interesting strategy. I said, okay, financial planning, that scares the bejesus out of you. But anyway, this is back in 2008. And I want to show you guys what this Exxon strategy would have kind of worked out for, because I think it's interesting relative to what I was talking about with this guy today. So this guy has, again, we'll just say $500,000. He's like, something, Josh, I'm just going to put in Exxon. He's got a lot more than that. He's got a lot more. But he's just saying he's got $500,000 that he could use as a pension. And he says, I'm going to use that and just buy Exxon shares, and I'm going to live off the dividends. And it made me think. I said, oh, man, it kind of what this lady said, going on 14, 13 years ago. Anyway, so let's check this out. So I want to show you guys something. So I got this quick little, just look at Yahoo Finance. I still love Yahoo Finance because it shows us. Actually, let me pause it. I got to get a pen. I think it was 2008 when I spoke to her. I just, off the top of my head, either 2008 or 2009. But what we're going to do is we're going to look at what the price was on Exxon in 2000. I hate that. 2008. Hold on just a second. And right there, let's see, right here. So we're going to say at the end of 2000, I think it's right there. All right, so it's 81.71. 81.71 is what Exxon was trading at, all right? So what we're going to do is we're going to take 500,000, got my trusty calculator. We're going to say she had 500,000 in there. Divide by 81.71. That gives us 6,119 shares. All right, good. So 6,119. I think I have that in there. 6,000. Okay, 6,119. That's what we want. All right, and that starts 2,000. Yeah, right there. Sweet. All right, good. All right. So what was happening is in 2008. This is the dividends that Exxon paid, and we just go back to this guy right here. Oops. And we want to go to historical data. We're going to go to dividends. All right. And then we're going to go to apply. Oops, I want to go back to, let's do to 2000 and what we said, 2008. There we go. Start date. Oops, 2008. And we're going to do this at 2020. All right. Done, apply. All right, sweet. So when I just download this, so we got 87 cents of dividends, what it paid last quarter. It looks like they pay 4 times a year, so every quarterly, 82 cents, 87, 87, 87. All right, so we're going to go all the way back to 2008, 35 cents a dividend, February 7, 2008. So I just did that in an Excel spreadsheet. 35 cents, 40 cents, 42, 44, all the way up to now we're at 87. So we've gone up almost triple in dividends, 300% in dividends. And what happens is we had 6,119 shares, all right, and that was paying us, going back to 2008, we got 2008, we got a total of, what's that, basically 10,000, a little bit less than 10,000 in income in 2008. Go back to 2020, we got 5323 times 4. We made 21,290. All right, so check it out. Now, 6,119 shares in 2008. That gave us $500,000. All right, why? Because in 2008, the price was. Hold on just a second. We're going to go back to historical prices. And we're just going to go to monthly. I think, what do we say the price was? 81 something? 81.71, right on. So let's go back to this. The price was 81.71. We're going to go to 81.71 was the price. So 81.71, 81.71 equals. And so we start with $500,000 at 81.71. So we're going to go here. We're going to go, oops, I got to go up here. Boink, boink. We're going to go to equals, oh, not right there. Hold on just a second. It'll make sense what I'm doing here in just a second. Equals this times, I'm doing Apple or whatever this is, sheets. I'm not all that familiar with it. There we go. So that's $500,000. All right, so what's it trading at now? What's Exxon right now is trading at 44, something like that. Exxon is trading at 46.58. All right, so 46.58. All right, 46 for 5/8, so times that times that. All right, so right now our $500,000 is worth $285,000. So a little bit more than half. We've lost half the value of that. I think what we could do, actually, we'd have to get the prices for all these. I don't feel like doing that. But anyway, so what's happening is we've lost in Exxon stock. We went from 500,000 to 285, so we lost that. But in the interim, we also made 203,000 in what's up, buddy? $203,000 of dividends, if that makes sense. So the course of, what's that, 13 years or so, roughly 13 years, we made $200,000 in dividends, and we were left with $285,000 as the value of the stock. So if we take the 200,000 dividends plus 285, we're still underwater what we started with in 2008, because we started with $500,000, and we're still at about roughly right at 5, but a little bit less than 5. Interesting. The alternative, though, was what if you did an annuity? And this is what I was talking about with this guy. And I basically said if you did an annuity, you would have got 5% annuity on $500,000 would have given you $25,000 a year without any income whatsoever, cost of living adjustment, just $25,000 a year. So we'll just divide that. So 25 times how many years you got? Hold on just a second. We got 2008, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So we got 13 years. So we would have made $325,000 in annuity income. But we had nothing left to show for it. All right, so we would have made more income in the annuity than we did in the in dividends. All right, but we have nothing to show for it because we took our capital. So isn't that interesting? So let's check this out. So here, just bear with me just a second. I'm not that good with these numbers that Apple has or Mac. I just got to get used to it. All right, so let's fast forward now. Let's say the dividends on Exxon continue to go, basically a tripling in value. If that makes sense. So if the dividends triple in value, by the time that we are sitting here in 2030, that will be paying not 53.23. Well, it won't be 2030. It'll be 2033. So 53.23 times 53.23 times 3 will be paying us about $16,000 a quarter. $16,000 a quarter is going to pay us $63,876. I mean, that's $63,876. I mean, that's real money, man. $63,000. The annuity is still only going to be paying us $25,000. That's it. I don't know how to draw that out here, so I'm not gonna. But so what happens is the annuity is gone. You're still getting $25,000, but the dividends, because the increasing dividends is tripling. We don't know if we'll continue that, but let's just say it even doubles. It's going to pay more than the annuity would, because the annuity is fixed at $25,000. In a couple more years, Exxon's dividend alone will be worth more than the annuity, if that makes sense. And you still have something to show for it, assuming Exxon doesn't go bankrupt. And right now it's at 283, but you still have something to show for it. Now, what did you do in the interim? Well, you had to take your cash out because it didn't pay nearly enough income relative to the annuity. So if you look back here, the first, it's only, what's that, $10,000. The annuity paid $25,000. So in the first few years, the annuity was paying significantly more. So you'd have to take that out from the cash because you weren't getting enough income. But then you fast forward 10 years later, you still got $285,000 in the share price. Yeah, and that's been hit hard. I get it. But the annuity is starting, the dividends is starting to give you almost as much income as the annuity did, and you still have the cash value of whatever the account is worth. If it's worth anything, it might not be worth anything. That's the risk. Man, I think that's freaking pretty cool. I didn't think about that until I just talked to this guy. And don't forget, the stock could go up too. Your stock goes back up to 80, you're back at $500,000. Yeah, I hope that makes sense. Something I've been thinking about. Something I've been thinking about. I've not drawn out that well, but it's just in my head. I figured I'd do a video. All right, love to hear your thoughts on that. All right, we'll see you.